I guess we can kind of explain how we got here in markets up 10% since the August lows on this premise that we should get an upturn in economic activity. We saw an industrial slowdown globally, and we got some decent numbers overnight in China. This ISM number not taken too well, at least on the first look by the U.S. markets. Does it change anything in terms of the premise of this rally and what we might expect into year end?
Well, we've looked at the last month or two, and we've said it seems a little bit odd to us. I mean, we do think stocks are going to be higher over the next year. We don't think we're headed into a recession. But you look at how markets have acted. They've acted like we're heading into this massive, sharp reacceleration in economic activity, and that just hasn't been our view. That's not what we heard in this last reporting season. I actually think this ISM number today actually dovetails pretty well with the tone we just got from 3Q earnings.
And Jim, how about you? I know you're looking for perhaps cyclical stocks to continue to build on their gains that they've seen recently, and that perhaps the markets are correct in figuring out that maybe we have easy monetary policy at the same time the economy is starting to look better. How does this number fit in with all that?
Well, it's a bit weaker number, Mike, but I don't think it changes a lot. I mean, the international numbers you said were better. A lot of numbers here have been better of late, too. The GDP Atlanta number just came way up to 1.7% for the third quarter or for the final quarter. What I'm impressed by, Mike, is the amount of unused capacity we have left, even though we're in the 11th year of an economic recovery and bull market. We've got a silent productivity miracle going on where productivity's popped up in the last 3 years from what it was in the 6 years prior to that fairly significantly. We've got a rise in the labor force participation rate, which is odd this late in the cycle. The job creation was up 1.4% in the last year, but the unemployment rate only fell 0.2 because we're having new entrants. We've got a surge in household formation going on because millennials are finally aging over 30 years of age. We've got a pristine household balance sheet with untapped positive savings sitting there and low debt to equity ratios. We've got a manufacturing sector which we can revive from a recession again. And we've got a wall of worry warts, which you wonder if we could still convert a few of those to some optimists. That's a lot of excess capacity for further economic recovery and further highs in this market. It's not going to be a straight line, but I think you want to buy on the dips here if we get some weakness.
Laurie, you just said markets are acting like there's going to be a sharp reacceleration. Right. So my sense would be you are not as bullish as Jim is.
Well, I think eventually I'd like to buy on a dip. I mean, we're looking for 33.50 at the end of next year, so we're not bearish by any stretch. But at the same time, this list of good stuff going on underneath the surface seems very priced in. If you look at the CFTC data on U.S. equity futures positioning, we've just hit a new high. I mean, well above where we were actually around the tax reform passage in late 2017. Valuations are telling a similar story. So we've hit peaks in positioning and valuation that have set markets up for bad news. I think that's where we are. We need to see a bit more of a dip, I think, before you jump in and buy.
I don't know. Jim, you're looking here at the numbers coming in, construction spending down at the same time. You've got new orders down. What does this tell you when you're looking for more optimism, when you think that we could benefit from a truce in this trade war, when it doesn't look like business is encountering the same kind of optimism?
Well, I think, we got a few bad numbers along the way. The Citigroup U.S. Economic Surprise Index has been up in the last few weeks. It's been up in the last few months even more. So we've had more better reports than worse. But, reports are very volatile. We're not going to get them all in a straight line. I would say if you look at all reports across the globe, Contesta, over the weekend and today, they've been pretty good. The German info is up, and the Chinese PMI broke back above 50 again. The France ISI went up again. We've had a number of pretty good international reports coming out specifically out of Europe and out of China. So I don't know if it's all that bad. I don't know if the values are that bad. If we do $175, I think street estimates for the S&P next year are a little better than that. You have 20 multiple on that. That's 3,500, and I think that's the type of upside we've got. And I think the downside here we're certainly going to get some, but I think it's protected by the fact of a lot of good things that are going on here. And how far can it fall before all this money on the sidelines could come in and buy in the dip?
Laurie, we did get Treasury yields up pretty sharply this morning, and it seemed like this, kind of a pop related to the overseas economic numbers. It seems like we're in a zone where Treasury yields are not going to be challenging too much for equity valuations, and yet, we could see some room higher toward 2% on the 10-year, perhaps, without that compromising things. You were saying you don't expect a recession, you expect stocks modestly higher. What's the path to getting to that target in 2020 in terms of sectors, in terms of the types of stocks you think should work?
So what we've told people is keep a modest bias towards value-oriented cyclicals. And if you look at things like industrials and financials, they're areas that tend to trade well when ISM is moving up. So we think that's eventually going to happen. And they're very, very cheap right now. Industrials have been close to financial crisis lows, same on financials. I think you want to be more careful in areas like consumer, where the resiliency thesis has been baked in, restaurants, specialty retailers. They look a little bit overvalued. Take some profits there. But we are also not really ready to give up our defensives entirely, so we're keeping our utilities overweight. Valuations actually look pretty neutral again on our model. So I would say, keep the value trade intact, keep a cyclical bias, don't fully abandon your defensives just
And those really big growth stocks that have been powering things, long-term secular growth?
So healthcare and tech are the two we've said we'd keep neutral views on. We've moved to market weight on tech. We've been neutral on healthcare for a while. We've kind of debated what to do there. We like the valuations, frankly, better on healthcare than we do on technology. We think the growth trade may sort of rear its head and keep working for the next, little bit here. It's not where we want to be longer term, but we'd keep a neutral on a couple of those sectors.
Can't remember a year, though, where we looked back and said growth wasn't what you wanted to own.
Well, we think that growth, it's not the right long-term call. It's very overvalued at this point in time. And when we look through all our lists of all the crowded names on the street, it's full of, a lot of these software stocks, for example, some of the communication services as well. We know 3-5 years down the road, that's not where we want to be in terms of our big overweights. But near term, it's sort of hard to argue against the momentum, I think.